You know, at the age of 68, I approach investment strategy very differently than I did at 40. Over the years, I've led JP Morgan Chase through 3 major financial crises. I've watched markets collapse and rebound, seen entire asset classes disappear almost overnight, and learned difficult lessons about what truly matters in the later stages of both career and life. When I was younger, I could afford to take chances. If I lost money in the stock market, I had decades ahead to recover. If a speculative investment failed, I could work longer, save more, and rebuild. However, once you cross 60, when retirement is close or already underway, and when you're relying on your investments rather than growing them, the rules change entirely. At this point, the primary objective is no longer wealth accumulation. The goal becomes wealth preservation. It's about protecting what you've spent a lifetime building and generating sufficient income to maintain your lifestyle without taking risks that could seriously undermine your financial security. Throughout my career, I've managed assets for thousands of wealthy families, many in their 60s, 70s, and 80s. I've seen strategies that succeed and mistakes that cause long-term damage. I've watched people make costly errors by chasing higher yields or getting drawn into the latest investment trend. At the same time, I've seen others enjoy financial stability by concentrating on 3 specific investment categories that have consistently proven their value over time. Let me clarify something at the outset. When I refer to safe investments, I'm not suggesting risk-free options. Risk-free investing does not exist. Cash loses purchasing power due to inflation. Government bonds can decline when interest rates rise. Even the most stable stocks can fall during market downturns. What I'm referring to are investments that share 3 essential characteristics for individuals over 60. First, they protect capital over the long term. Second, they produce reliable and predictable income. Third, they demonstrate stability across multiple economic cycles. The first genuinely safe investment for people over 60 is U.S. Treasury securities, particularly Treasury inflation-protected securities, commonly known as TIPS. I understand the reaction many people have. Government bonds are viewed as dull. They don't promise extraordinary returns. You won't build significant wealth through Treasury securities, and that is precisely the point. At this stage of life, predictability matters. Stability is valuable. Safety takes priority over excitement. Here's why TIPS should serve as the foundation of a retirement portfolio. First, they are backed by the full faith and credit of the U.S. government. Despite political challenges, national debt concerns, and economic uncertainty, the United States has never defaulted on its debt obligations, not once in its 250-year history. The government has the ability to issue currency, controls the world's reserve currency, maintains the strongest military, and operates within one of the most stable political systems globally. Regardless of economic disruptions or global crises, U.S. bondholders are paid. Second, and this is especially important for retirees, TIPS are designed to protect against inflation. The principal value adjusts upward based on changes in the consumer price index. If inflation is 3% in a given year, your principal increases by 3%. If inflation reaches 5%, your principal rises accordingly. This protection is critical because inflation quietly erodes retirement portfolios. For someone living on fixed income, a 3% annual inflation rate can cut purchasing power in half over roughly 23 years. A retiree at 65 could experience a substantial decline in living standards by age 88. With TIPS, income automatically keeps pace with inflation, preserving purchasing power and reducing concerns about rising costs for essentials such as food, utilities, and healthcare. Third, TIPS currently offer appealing real yields. Real yield represents returns above inflation. For much of the past decade, real yields were negative, effectively meaning investors were paying for safety. Today, however, TIPS offer real yields in the range of 2% to 2.5%, providing a genuine return after inflation. At JP Morgan, I typically recommend that individuals over 60 allocate between 40% and 60% of their portfolio to TIPS, depending on their income sources and risk tolerance. Those with pensions or strong Social Security benefits may be comfortable closer to 40%, while individuals relying mainly on investment income may prefer 60% or more. The second truly safe investment for people over 60 is high-quality corporate bonds issued by financially strong, well-established companies. While government bonds offer superior credit safety, corporate bonds provide higher yields. For retirees living off investment income, that additional yield can meaningfully improve overall living standards. But here's the key. You need to be very selective. You cannot simply purchase any corporate bond just because it offers a higher yield. The focus should be on companies with solid balance sheets, reliable cash flows, and a long history of meeting their financial obligations. At JP Morgan, we rely on a dedicated team of credit analysts who assess corporate bonds based on financial strength, stability of the business model, and the quality of management. The companies that qualify for retirement portfolios are usually large, well-established firms with strong market positions and predictable earnings. Consider companies such as Johnson & Johnson, which has raised its dividend for 59 consecutive years and maintains one of the strongest balance sheets in the healthcare sector. Microsoft is another example, generating substantial cash flow through software subscriptions and cloud services. Coca-Cola is also a strong case, having paid dividends for more than 100 years and owning a global brand that is extremely difficult to replace. Bonds issued by these companies generally yield about 1% to 2% more than comparable government bonds, yet their credit quality is nearly as strong. The default risk is very low, and the additional yield can meaningfully improve retirement income. I generally suggest that individuals over the age of 60 allocate between 15% and 25% of their portfolio to high-quality corporate bonds. Diversification across different companies and sectors is important to reduce concentration risk, while still maintaining exposure only to top-tier credits. One important risk to monitor with corporate bonds is interest rate risk. When interest rates increase, bond prices decline. However, if you plan to hold the bonds until maturity, this price fluctuation is not a major concern, as you will receive your principal back regardless of short-term market movements. The third genuinely safe investment option for people over 60 is dividend-paying stocks from companies with long records of consistent dividends and conservative business practices. I understand the concern. Stocks are volatile, and they can lose 30% or even 40% of their value during market downturns. That is true. However, dividend-paying stocks from established companies carry a very different risk profile compared to the broader stock market. The key is to concentrate on businesses with defensive characteristics. These are companies that provide essential products or services that people continue to need regardless of economic conditions. This includes utilities supplying electricity and water, consumer staple companies producing food and household goods, and healthcare firms delivering essential medical services. These businesses typically maintain stable earnings and cash flows even during recessions. They also tend to pay reliable dividends, offering steady income to investors. While their share prices may fluctuate, they are generally less volatile than the overall market. Let me offer a few examples of the types of companies I mean. Procter & Gamble produces everyday items such as Tide detergent and Crest toothpaste, products consumers continue to purchase even during economic downturns. The company has paid dividends for over 130 years and has increased them for 67 consecutive years. Another example is NextEra Energy, one of the largest electric utilities in the United States. Electricity usage does not decline during recessions, and its regulated business model generates predictable cash flows. The company has raised its dividend for 28 consecutive years. These types of stocks serve two key roles in a retirement portfolio. First, they generate current income through dividends, with many offering yields between 3% and 5%, which can complement bond income. Second, they provide a degree of inflation protection, as these companies are often able to raise prices when costs increase. I recommend that individuals over 60 allocate 20% to 30% of their portfolio to dividend-paying stocks, with one important condition: you must be extremely selective and focus only on the highest quality companies with long dividend histories. It is also essential to recognize that stock prices will fluctuate, even for the safest dividend-paying companies. During the 2008 financial crisis, conservative utility stocks declined by 20% to 30%. In the 2020 pandemic, many dividend-paying stocks also experienced significant short-term declines. The critical point is this: if you own high-quality dividend-paying stocks and do not need to sell them during market downturns, you can continue collecting dividends while waiting for prices to recover. Over time, strong companies do recover. Now let me address some common investment mistakes I often see among people over 60. The first is reaching for yield. When interest rates are low, as they were for much of the past decade, many retirees become frustrated with the limited returns on safe investments. As a result, they move into riskier assets offering higher yields, such as junk bonds, preferred stocks, dividend stocks from financially weak companies, real estate investment trusts, or master limited partnerships. The issue is that higher yield almost always comes with higher risk. At this stage of life, you cannot afford to take significant risks with money needed for basic living expenses. During the low interest rate period from 2010 to 2020, I had numerous discussions with clients who wanted to invest in high-yield bonds or dividend stocks from companies I would not even consider lending to. They were focused on gaining an extra 2% or 3% in yield and were willing to put their principal at risk. This is a mistake. Earning a safe 3% is far better than chasing 6% and risking a 30% loss of capital. The second common mistake is market timing. Many retirees believe they can improve returns by moving in and out of the market at the right moments. They sell when markets decline and buy when prices rise. This approach is exactly the opposite of what works and almost always leads to poor results. I have spent more than 40 years in the markets, and I can say with confidence that market timing does not work, even for professionals equipped with large teams and advanced analytical models. For individual investors, particularly retirees who manage their own portfolios, this approach often leads to serious problems. The third common mistake is overconfidence. Many people who have been successful in business or professional careers believe those same skills automatically translate into investing. They begin selecting individual stocks or chasing what they believe is the next promising sector. However, investing in public markets requires a very different skill set than running a company or working in fields like medicine or engineering. It demands a solid understanding of financial statements, industry behavior, valuation techniques, and broader economic trends. Most individuals lack this expertise, which frequently results in expensive errors. The fourth mistake is inadequate diversification. I often see retirees allocating too much of their savings to stock from their former employer because they feel familiar with the company. Others invest only in U.S. assets due to limited knowledge of international markets, or they avoid bonds entirely because they assume stocks will always deliver superior returns. Effective diversification across asset classes, regions, and individual securities is essential for risk management, especially after age 60, when recovering from large losses becomes far more difficult. The fifth mistake is overlooking taxes. Many retirees fail to carefully consider which investments belong in taxable accounts versus tax-deferred accounts such as IRAs and 401ks. They often ignore the tax consequences of their decisions. This is especially critical in retirement, as your tax situation can be very different from when you were working. You may fall into a lower tax bracket, making strategies like Roth IRA conversions more appealing. It may also be beneficial to place tax-inefficient investments in tax-deferred accounts while holding tax-efficient investments in taxable accounts. Let me also address several broader economic issues that individuals over 60 should keep in mind. The first is inflation. After many years of relatively low inflation, we have experienced renewed inflationary pressure. Although inflation has eased from recent highs, I believe we are entering a period of structurally higher inflation driven by deglobalization, aging populations, high government debt, and the increasing use of the dollar as a geopolitical tool. This is particularly challenging for retirees who often rely on fixed incomes that inflation can steadily erode. This is why Treasury inflation-protected securities and dividend-paying stocks are so valuable, as they offer some defense against rising prices. The second concern is longevity risk. People are living longer than ever. A healthy 65-year-old today has about a 50% chance of living to age 90 and a 25% chance of reaching 95. This means your retirement savings may need to last 30 years or more. This creates a difficult balance. Your portfolio must grow to preserve purchasing power, but it also needs to be conservative enough to avoid significant losses. A balanced strategy that includes tips, high-quality corporate bonds, and dividend-paying stocks helps address this challenge. The third concern is healthcare costs. Medical expenses generally rise with age and often increase faster than overall inflation. Long-term care costs in particular can severely impact retirement savings. That's why it's important to budget cautiously and consider setting aside part of your portfolio specifically for healthcare needs. Some retirees choose long-term care insurance, although it has become more expensive and coverage options are more limited than in the past. Now let me offer some practical guidance on how to apply this investment strategy. First, determine your income requirements. Calculate how much money you need each year to cover essential expenses such as housing, food, utilities, healthcare, and transportation. This forms your survival budget, and it should be funded with the safest investments, including tips and high-grade corporate bonds. Second, Estimate how much additional income you want to support your preferred lifestyle. This could include travel, entertainment, family gifts, or charitable donations. These expenses can be supported through a mix of dividend-paying stocks and additional bonds. Third, maintain sufficient liquidity for emergencies. I recommend keeping 6 to 12 months of expenses in a high-yield savings account or short-term treasury bills. This provides both flexibility and peace of mind. Fourth, rebalance your portfolio on a regular basis. Asset allocation matters more than selecting individual securities, but you must keep your target allocation intact as markets fluctuate. If stocks perform well and exceed your allocation, trim them and add bonds. If bonds outperform, adjust in the opposite direction. Fifth, consider working with a fee-only financial advisor who specializes in retirement planning. This can be especially helpful if your portfolio is large or your finances are complex. Ensure the advisor acts as a fiduciary, meaning they are legally obligated to put your interests first. Let me also address how much you can safely withdraw from your retirement portfolio each year. The traditional guideline was a 4% withdrawal rate, but that rule was developed when interest rates and bond yields were higher. In today's environment, an initial withdrawal rate of 3% to 3.5% is more realistic, with the understanding that spending may need adjustment based on market conditions and portfolio performance. This is where the flexibility of a balanced approach becomes valuable. If stocks have a weak year, you can reduce withdrawals from that portion and rely more on bond income. If bonds struggle due to rising interest rates, you can depend more heavily on dividend income from stocks. Finally, I want to stress the importance of discipline. Avoid being swept up by market excitement or fear. The media constantly promotes new investment trends, hot sectors, or crisis narratives that claim urgent action is required. Ignore the noise. Focus on fundamentals. Stay committed to your allocation of tips, high-grade corporate bonds, and dividend-paying stocks. Make gradual changes as your situation evolves, but avoid major shifts driven by short-term market movements or headlines. At this stage of life, your priority should be preserving capital and generating reliable income, not chasing the highest possible returns. The goal is to feel confident that your portfolio can support your lifestyle regardless of market conditions. These three investment categories, tips, high-grade corporate bonds, and dividend-paying stocks, have consistently provided income and stability for retirees through every market cycle and economic downturn in modern history. They may not be exciting or fashionable, but they are effective. And when you're over 60, effectiveness matters more than excitement. The choice is yours. You can pursue the latest investment trend and risk your financial security, or you can rely on proven strategies that have supported retirees for generations. I know which path I would take. I know the approach I'm following, and I know what I will recommend to my own family members when they reach retirement. The real question is, what will you choose?